Um, Hello, good day, everyone. Welcome to our another class section review of our weekly commentaries. So, in this our class section, we are going to be discussing, or I'm going to be showing you my weekly commentary reviews on the V51X, over here. So, a lot of you guys dropped most of your analysis on what we expect for our weekly market review. So I'm going to be dropping a commentary on that to be showing you guys what I'm seeing and what the algorithm is anticipating for and where our drawn liquidity is. So without wasting much of our time, it's going to be a quick one. I don't want to waste too many much time. So number one, so let's just get started. So now we have to define the first rule is that we have to define our bias and our narrative. And how do we define that? So I want you guys to pay attention. Number one, if the algorithm is drawn, I've always said this over and over again. If the algorithm is drawn to an higher time frame, this PD array, then it will either be hunting for either bullish or bearish setup. So what I mean there is that if the algorithm is drawn to a higher time frame premier array, understand, then the algorithm bias will be hunting for bullish setup into a higher time frame discount array. So thereby all lower time frames will be going for long positions. So if what I mean there is that if the algo is seeking to go into premium, meaning it's going up, then its algorithm will be hunting for bullish setup that's inside of a discount array premise in all lower time frame to frame long positions. So the same can go likewise for the opposite direction of that, or the opposite of it. So that would be that the algorithm is drawn to a discount array. Like if the algorithm is drawn to a discount array, meaning it wants to go down, then the algorithm bias will be hunting for bearish setup inside of a higher time frame premium premise, all lower time frame. It will be hunting for bearish setup inside of a higher time frame premier array. So all lower. So when you now zoom down, you'll be hunting for bearish setup in all lower time frame to frame out high probability short positions. You understand? So that's why it's very important to firstly determine where the market is likely to go and where it's not likely to reach for, or where it's not likely to go, so as to know the next drawn liquidity, and this will make you a better trader. Before you start looking for entry techniques are the last thing you look for, and that will only happen when you wait. Remember, the algorithm is designed to manipulate us with human behavior, psychological behavior. It's manipulating us with a human psychological behavior, which is in the form of what? Greed. So greed is the only thing that drives us in this market, nothing else. You might know whatever, you might know everything you need to know in the marketplace, but once greed sets in, greed is what makes everyone in this industry to be what? It makes everyone in this industry to be impulsive. Impulsive means you want to always go into the market and understand, you want to go into the market and do something. So you have to sit down and wait for the setup to pop out in front of you, so you can be able to know the right thing to do. So with that being said, let's just get started. So now I want to be showing you my own market review, or my own weekly commentaries on the back and market review on V50 warnings, and what I think concerning it, or what my thoughts is concerning it, based on what I see, or based on my what do you see theory. So now so we see that we are bullish on our higher time frame, on the monthly time frame. Let me zoom. Can you see? So I've zoomed in. So we are bullish. We are essentially bullish. So we've gotten to a point where the algorithm has finished all of its business. That's nothing to keep doing anything to push price. So now it's seeking to push price where lower. So we've seen this last off close candle, but I would not want to take this as the last off close candle, because we have one big candle engulfing all this candle. You understand? Even two. So if this will change to a this has started becoming a sell program. So if this sell program will want to break, it will either close and break. I'm verging for this first candle. It will break aggressively down with this series of down close candle moving to break this. Once this is breaking over here, then I will say a high probability valid bullish order block has been created. And if it does that with a very expansive candle, then I will know that yes, it has changed. So let me just break down the analysis. So we are going to be using more of the weekly, because the weekly shows more of what we are doing. So I'm going to drop to the weekly time frame so you guys can see what I am seeing also on my chart. So here's the weekly. I've dropped down to the weekly, so I'm going to annotate this now. And one more thing again is that I want you guys to understand something. We are looking for buyers now. So the narrative, we still talk about the narrative. So what is bias? A lot of people, narrative means how the algorithm is going to deliver towards the bias. So what is bias? So bias bias actually can be defined as, understanding where the higher time frame, monthly or weekly or daily drawn liquidities are located. Just like the definition that I told you, that if the algorithm is drawn to a premium array, if it's drawn to a premium array, it means it wants to seek for a bullish for a buy program. So if it's drawn to a discount array, then the algo bias is seeking for a sell program. So it's very, very simple like that. So bias is defining and understanding where higher time frame, monthly or weekly or daily drawn liquidity is. So now for this, I'm going to annotate my charts. We are going to use the weekly and the monthly. So that is the bias everybody should be using. When you want to work on your chart, make sure you note the monthly, even the three. Once you can define the weekly and the monthly, and they both align, agree together, the daily should not be hard for you to look for. So that daily you can easily find. You can just be refining the daily in alignment with the weekly and the monthly bias, higher time frame bias. So without wasting much of our time, let's just get started. I don't want this video to be too long, so let's zoom to the weekly. So this is the weekly. So I'm going to annotate my chart and I will explain what I've done. So just wait, let me do that now. So now this is the monthly. I want to show you what I've done on the monthly. So on the monthly, this is the bullish order block. This is a bullish order block on the monthly. So we have a bullish order block. This is the main threshold of that bullish order block. This is the line, and this is the opening price. Price respected this. When price tap into that opening price, do you see that algorithmic price respected it? Previously, when price was coming into this main threshold, the market went up aggressively and did all this I will explain, not this one for the weekly. I will explain how that. So when we go to the weekly, you see all this. So now we have what again? We have a fair value gap. Now a lot of you were marking this high, this low to this high. That's not your fair value gap. Your fair value gaps will starts from here, because do you see, this is the overall fair value gap. Fair value gaps can be nested. Yes, that's what this is, nested PDRAs of fair value gap. So we have a fair value gap here from this low to that high. It's a fair value gap. Then from this low to the next high is a fair value gap. So you take the last high. If you are seeing multiple fair value gaps in the self, you take the last low to the last high. So the last high to the last low, all the fair value gap that is in between it, you take it and you take it as one big fair value gap. Then you look for the what? You look for the mean threshold, the CE. Now look at what we see. A price tap into that, respected it. So this is a balanced price range. So a balanced price range is when the algorithm respects, either with a wick or a body, at the high of the fair value gap, the main threshold of the fair value gap, and the low of that fair value gap. Sorry, not the main threshold, the consequent encroachment of the fair value gap, I mean to say. So do you see what was happening here? Look at here. When price dip into it, respecting it, after breaking it, respected the main threshold, the consequent encroachment of that fair value gap, not the main threshold. Then what happened? Price rally up. This is a monthly time frame, mind you. So 1 month. So you understand if you were trading in this consolidation. Now look at all these candles. Whenever you see candles like this on a higher time frame or even on a lower time frame, when you drop down to a lower time frame than the preferred selected time frame you are looking at, this is consolidation. When you begin to see all this back and forth movement, all this kind of tiny candle, doji candle like this, they are just repeating themselves. Smaller candle, small range candle, not large range candle. So this was expansion, then this was a breakout and all that. So the market was still consolidating like this. But you don't need to be worried about a monthly candle. So let's move on. You can trade even one single monthly candle back and forth, even before it close and open. The OHLC of this monthly candle can be traded when you know how to break the narrative down. So now this is a fair value gap, and this is the monthly consequent encroachment of the fair value gap. This is the BC. Look at that price. None of the bodies closed at the monthly CE of the fair value gap, BC. Then what do we have here again? Here we have the what? The opening, another block. So this is also an high probability order block because its main threshold was respected. Well, if we didn't see any fair value gap, but you need to go down to a lower time frame to look for that fair value gap. So its main threshold was respected, then price rallied up. So let's go to the weekly time frame. So now here's the weekly time frame. Now look at the weekly time frame. Look at what we are seeing here. So we have firstly we have the longest week, and after the longest week we have what? We have another week trading through this week, the body of the week here. We have another week trading through the body of the week there, and this is why I say I mark this as my weekly bearish rejection block. So this is your rejection block. This is just the quarter of the week. This is a quarter of a week. So we like to see this very well. It's a very good algorithmic price move. Then inside of this weekly we have we have the last off close candle that was traded through aggressively. It validates the weekly monthly order block, the 50%. So that's the 50% of the main threshold. That is a white line. The white lines are for the weekly, mind you. So we have we have the weekly consequent encroachment of this gap, also the fair value gap from this high, let me zoom, from this low, to that high of these 3 candles. So this is where the gap was, and that's what I delineated here. So this is that same monthly. Look at the same monthly mean threshold. This is the opening price. The second line is the opening price. Let's move on. This is the monthly fair value gap consequent encroachment. Look at the way it was respected. Imagine that. That's beautiful. Respected. Even look at the main threshold. The main threshold was even sitting inside. Look, the consequent encroachment of the fair value gap was even sitting inside. Let me take this outside. It was even sitting inside of this bullish order block. So I think they are in close proximity together. So this is the monthly main threshold order block. Look at that. So this is a gap, and you extend that gap from this high. There are gaps, there are lots of gaps here. So if we use this to that low, we extend it, it's going to give us another kind of reclaimed fair value gap, but it also has its own. That will be another thing else that I will discuss later. So now let's look at the buyer. So now we saw that the monthly time frame that they are now, because of what we see on the monthly time frame now, the algo is seeking, according to my own precision. This is where I observe that the algo is seeking for. So this fair value gap is a balanced price range. So I'm expecting that the algo gets down here, test this, whatever you guys might say this is a fair value gap it want to close, test this weak, you can weak into this one, test it, weak it, and rally off again. So I would not expect it to break the body of this fair value gap by side, because they were respected here. None of the bodies closed and this overall nested fair value gap over here. So now let's go to the weekly. Let me just focus on this area. Now we know these are drawn liquidity. This is our bias now on the monthly time frame here. So this monthly CE of the fair value gap, the consequent encroachment of the fair value gap BC, is our bias on the monthly, and also this order block is also our bias. Once this order block is broken with the body candle close, this candle is broken straight through, then this is the next one. So this is the nearest one we are looking at. So let's go to the weekly and see what's going on our chart. So now this is the other block I was talking about. This is still going to happen. It's going to take a very long time. So now I'm expecting the market to either break this bullish order block that was respected here, that pushed price aggressively up, or price respect this and reject back. It's either of the two. But if price reject it back, it must still touch it. So you can look for, how do you say it, you can look for, a bread and butter setup. Now look at this long week is also a target for it to break down into these key levels. It can break down from this low, but it can break down from the opening of this monthly bullish order block. But the monthly bullish order block main threshold we should see it being respected like how it was being respected here. So now let's drop down to our daily time frame. On our daily time frame, oops, so this is what we are seeing. Now look at that. Now look at this that I draw here before this rejection block. So this is what happened and make the price went down aggressively down to this place. Now do you see how algorithmic this thing is? Let me zoom in for you guys so you guys can see. Now look at this quarter of the week. Look at price respected this. The body did not close above it. It was respected, just weak it. Do you see that on the daily time frame? After closing this fair value gap that is here, just wicked it. Then we have setups here, price falling down to this side. This is beautiful, guys. Now look at the main threshold of this, the consequent encroachment of this. Look at how it was respected too. Do you see that? This was the consequent encroachment of let me zoom out. This was the consequent encroachment of the weekly. See, look at it on the monthly and look at the weekly order block, the main threshold of that last two candles that we saw. Look at them on the daily time frame, how they look like. Now look here. Here was respected, algorithmic. Here was respected too. Respect it, fine. And look at this place too. Look how algorithmic that place is. Let me zoom. This that. The price just respect the move. Just tick, just wick into it like that. Just wick into it like pim like that, and went up. Now we have this consolidation in the daily time frame. There's consolidation on our daily time frame, and this consolidation is called time distortion. So this is when you just sit down and wait. You don't do anything in this place, so don't play smart. If you are even smart, just avoid the greed. You have to wait. Took how many days? 1 2 3 4 5 6 7 8 9 10 11 12 13 days before the expansion. This is where you want to do the real magic. So once the expansion has happened, then you should know that here is your next target. Here is the nearest dawn liquidity. This is the short-term low to this initial low here, the overall low, the long-term low on the intermediate term low, anyone you want to call it. So now there's something again you guys should look at. What do you see here? What do you see? Do you see this? Now do you see this? What do we have? We have what? We have a high, a low, and a higher high. this high was taken out, where buy side liquidity was taken and went into our consequent encroachment of our weekly fair value gap. Do you see that? You guys are not seeing that. Okay, there's a high. This is a bearish breaker. A bearish breaker that is having a high, a low, and a higher high. The low that took this high now make it to form a higher high. Now what do we have? We have what this key level took it into that key level and it was respected. So we should expect this low now to be taken. This validates our bearish breaker once this lower has been taken. Let me just take it away, put the picture clear for you guys. Now do you see that? Do you see what I'm showing you guys? So here validates the bearish breaker once this has broken that structure. So this is where the obvious break market structure we want to be seen. Although the price can still do a little rally, you understand, maybe close this fair value gap before it comes eventually to break this. But once this is breaking, it validates the bearish breaker and it begins to aim for our weekly bias, which is this. You understand? So this is what we are seeing here. So it aims for a weekly bias. Once this one too has been broken, it aims for a monthly bias. So for it to aim down to that weekly bias, from there down, if it breaks this low, that's 25 to 24,000 pips. The points divided by 100 gives you 24,000. If it breaks the main threshold, 53,000 pips, then if it breaks it all the way down here, that's 150,000 pips. Although it's going to take a very long time for that to happen. So we cut through candles, so we work bit by bit. So this is the first draw on liquidity. So that first draw on liquidity is what? 26,000 pips. So that's the point. The point is 26. How many points is that? That's 2.6 million points divided by 100 give you 26,000 plus pips. So we aim for this. For this our first target and this our second target. So we aim for this. So this is what I'm expecting price to juicy to attack this. This is a juicy, it's very juicy. So this is a juicy target, a draw on liquidity. So this is what I'm expecting price. So this is my first eyes. My eyes is here. So I want to be looking for one setup or whatever price is going to do to attack this draw on liquidity here before I move to the next one. So the next one will only happen maybe if it was a strong aggressive. Normally if this candle close today on the daily time frame, we can expect something to happen here strong. So do you see that on the daily? So on the daily already we have our bearish breaker block. So our bearish breaker block on the daily is what I've just shown you guys. Do you see do you see how price respected these levels? So now all these things I've showed you shows that the price is showing willingness to go down. So this is a sell program very beautifully. So this is something many will not know is happening here. So look at that. So this is where I'm expecting. So now if I see price give me any sign to attack this draw on liquidity, I'm going to take that shot to this drawn liquidity, and this is my target. So this is why I say you guys should note the key levels on the higher time frame and identify the higher time frame drawn liquidity, which will define your bias for you to work with. So this is where you get the narratives. So this is just a narrative of a bearish breaker that was happening here, a high, a low, a higher high. Then once this low is broken, we anticipate that the market will come down, then retrace into the last series of down close candle, or the last down close candle. It can be this one, any of them, but that's what we are anticipating now. So if I want to anticipate, I will anticipate with these large range candles, not this last down close candle. But first we must see how far price validates, because we already have a fair value gap here. So if we cut through candle, this fair value gap becomes an inversion fair value gap. So an inversion fair value gap is when candles are being traded through. When a fair value gap that is broken is an inversion fair value gap. So once a fair value gap is traded through, which is supposed to push price the direction it's ought to, like this CB supposed to push the price down, but it's traded through into somewhere, maybe this fair value gap. Now this one is traded into fair value gap, but we are not concerned of this, we are concerned of this. So this can be used also. You can extend that in time, look for the consequent encroachment of this. Price may break this and eventually come back to this level and move forward. So this is called the inversion fair value gap. It is a fair value gap that is broken just for it to reach into a price run or a Judas swing or whatever. So then if the market comes back into trade through it, if we trace back, we should expect the key levels to be respected. So this is my drawn liquidity. So that's where I'm aiming that the market will come to here and come to there, although there will be a back and forth movement. So that's all I have to show you guys. I hope this video was insightful, this class was insightful to all of you. And if you have any comments or anything to say, just say it in our Telegram channel, in our private Telegram, in our public Telegram channel, not our private. So just post whatever you have to say in your mind, whatever you have in mind. Just ask any question you want to ask in mind, then I will do my best to answer them for you guys. So until then, see you later, take care, and have a wonderful and blissful week.